These are things that we'll be tracking very closely. For now, it's a good time to discuss market fundamentals. Chirag Mehta, CIO of Quantum AMC, is joining us now to discuss more on that. Chirag, good morning. Thank you so much for joining in. Well, it's been a sudden fall that we've seen from the highs, and this has come in after that 2 days of continuous selling that we saw on Thursday and Friday. What are markets pricing in? Do you think most of those elevated valuations are something that would start coming down and there is more to go from these levels?
Yeah, thank you, Sonal, for having me. Yes, valuations were clearly on a higher side. There were very few opportunities that were looking attractive from a valuation standpoint. Given that valuations were significantly higher in the mid and small cap space, and also if you look at even in the large caps, as we're incrementally getting expensive, barring a few pockets of opportunity. So overall, I think this is a good, healthy correction that we are seeing in the markets. As valuations become more reasonable, probably that will be a good time to get back into the market. So if you look at our positioning as well, we were sitting on some cash in the portfolio, given that there were less opportunities available, and hence probably this decline bodes well for us from a opportunity standpoint. And we will be looking at valuations wherever pockets. In whatever pockets there is opportunity that arises, we will be buyers into those pockets.
But have you already started buying, Chirag? What is the cash on your books? Have you deployed part of it? If yes, and also weigh in on this entire India versus China rotation out of India into China and China-related names.
Yes, Reema. So in the value fund that we have, we were about 14% odd cash, and in the small cap fund, we were around 16% odd cash. And cash is not a call that we take; it's a residual of our process. So given that nothing was hitting our buy zones, the resultant of the stocks that were hitting our sell was the cash that we had in the portfolio. From a global investor standpoint, clearly Chinese market were really attractive from a valuation standpoint, but if you look at the differential between the Chinese valuation versus Indian valuations, it was a tale of two markets. Significantly higher Indian valuations versus significantly cheaper by all counts from a Chinese valuation standpoint. So given that, opportunistically, given the stimulus that we saw in China and the valuation that it was available, there was a tactical play at hand, which led to many allocate to China in a rush. And hence, we have seen that Chinese market zoom up significantly in a short span of time. Given that, I don't think it's a more structural story, given that there is uncertainty or elements why investors were pulling out of China haven't changed. And this looks more like a tactical play as opposed to more a structural play. So I think India, from a structural standpoint, remains a much better market to be in, provided valuations correct, and we are seeing some correction take place. So if that continues, that would be a good opportunity even for foreign investors to start looking at Indian market more seriously.
So when you're saying the long-term story remains structural and the valuation part is the concern, are there any pockets where you think if there is some more correction, you would look at eyeing those and buying into them? Is there something that is of your liking?
So from a structural standpoint, plays like power, industrials, etc., still have a lot of runway left. We think, but from a valuation standpoint, there was a need for correction. Everyone's trading very, very expensive. And hence this correction, if it is meaningful, will give us opportunity to be in those pockets. So currently there were some pockets of relatively cheaper or relatively reasonable valuations, but most of the pockets in terms of consumer discretionary to power to industrials, etc., was all trading very, very expensive. But now with this correction, if it lasts for some more time, probably may give us the opportunity to look at those areas as well.
Chirag, what is a meaningful correction, right, in the market? This is a market which is impossible to predict. So even retail investors don't know whether this is it in terms of a correction. Should one be buying today or should one wait out for even lower levels? So when you say that in power industrials, a correction was due, it's a healthy correction, and you're going to look to buy when, perhaps there is a meaningful correction, how would you define it? Would you look at 5-10% lower levels from here on? What's the real advice in terms of go out and buy today?
So we are bottom-up stock pickers, and we look at each opportunity on a bottom-up basis. And hence, it will be difficult to pinpoint a number on the index because index is very different as opposed to sectors and companies. And from that standpoint, even at the index level, probably, 10-15% correction will be meaningful enough to start getting opportunities in various sectors and companies. Because if index corrects probably by, say, 15%, probably stocks which were expensive and, come under some sort of selling pressure, probably may correct more than that and hence give you those opportunities that you're looking for.
By the way, a mild recovery on the Nifty is just 60 points from the lows after that fall that we've seen. But something like an HUL, the Tata Steel, Titan, M&M, some of these consumption names are leading to that mild recovery that we're seeing on the Nifty. But of course, it's coming after that major fall that we've seen from the highs. Chirag, anything from the banking space? How are you looking at that particular index? Because there's a lot that's happening. We got the Q2 updates that have come by as well. What's your take?
So it's one space that we have liked because valuations are still reasonable in that space. And it's time when, you're seeing some pressure on NIMs, on credit costs, etc. Not really in the banking space, but in the space of MFI, etc. You're seeing some credit costs come in, which may get, spilled over into segments going forward. But having said that, all those banks which have been prudent in their lending have that franchisee to attract deposits. Credit growth has been slowing a bit, but barring those concerns, valuations, given the growth that is probably expected in that sector, still look reasonable. So we have a high allocation in our portfolios to BFSI as a space and private banks in particular. So we like that space from a valuation standpoint and also adjusting to the growth or pressure on NIMs that you would expect going forward. Still, that looks a reasonable place to be in.
Okay, thank you very much for that. Get into a break.